Welcome to the deep dive. Okay, so you've brought in quite the stack here. Looks like an article, some research, your notes, all focused on the U.S. bond market, right?
That's right, and we've dug into all of it. The goal for this deep dive is really to unpack what your sources are saying the bond market is signaling, what that could mean for the economy overall, and, maybe most importantly, what it means for you.
Right, because the bond market, it's often seen as the sober one, the rational part of finance, debt, promises, that sort of thing.
hmm
But this material you shared says it's flashing warning signs. We're seeing yields jump up sharply, some really unusual behavior.
Yeah, these aren't just small wiggles on a chart. The signals your sources describe, they seem to point towards some real underlying stress. So let's try and figure out what's actually going on, why now, and pull out the key insights from your stuff.
Okay, sounds good. Let's start with the basics then, just to ground ourselves based on your sources. What exactly is a bond in simple terms?
Well, fundamentally, a bond is like an IOU. It's a debt instrument.
Yep.
You, the investor, lend money to someone, could be the government, could be a company,
Okay.
and they promise to pay you back the original amount of the cheerio, the principal on a set date, the maturity date. And usually they also make regular interest payments along the way, the coupon payments.
So, unlike stocks, where you own a piece of the company, with bonds, you're basically the lender.
Exactly. You're the creditor.
Yeah.
And your material makes a really important distinction between corporate bonds and U.S. Treasury bonds.
Yeah, tell me about that difference.
Well, corporate bonds,
Yeah.
they come with different levels of risk, because companies unfortunately can go bust, fail to pay back their debt.
Right.
U.S. Treasury bonds, though, they're backed by the full faith and credit of the U.S. government, which makes them, well, pretty much the safest investments you can find anywhere in the world.
That's why they're called a safe haven then.
Precisely. Especially when things get choppy elsewhere, investors often run to treasuries for safety.
Got it. And the research you looked at mentioned different types of treasuries based on how long the loan is?
Yep. Your sources break it down by maturity. You've got treasury bills or T-bills. Those are short-term, less than a year.
Okay.
Then treasury notes, T-notes.
Mm-hmm.
They're medium-term, maybe 2 to 10 years. And then the long ones, treasury bonds, which can go out 20, even 30 years.
And there was a note in there about taxes.
Yeah, good point. The income you get from these treasuries, it's typically exempt from state and local taxes, which can be a nice little bonus depending on where you live.
So why do people buy these things, especially treasuries? What's the draw?
Well, the material highlights a few key reasons. Safety is a big one, obviously, with treasuries being almost risk-free.
Mm-hmm.
They also give you a pretty predictable income stream from those interest payments. And they help diversify a portfolio. So if you have riskier stuff like stocks, bonds can act as a kind of anchor.
Stability.
Yeah, exactly. Historically, that perceived stability of U.S. debt has made treasuries just fundamental to the whole global financial system.
Okay, so that's the normal picture. Stable, safe haven.
Yeah.
Now, let's get into the alarming stuff your sources are talking about right now. What's been happening?
Right. This is where it gets pretty interesting and maybe a bit concerning based on the analysis you provided. The biggest thing recently is this sharp, sudden rise in treasury yields.
How sharp are we talking? Do the sources give specifics?
Oh, yeah. Your material points to the yield on the 10-year treasury note. That's a key benchmark, jumping by nearly 50 basis points.
In just 1 week.
50 basis points in a week. Wow. Just to clarify, a basis point is 1/100%, so that's half a percentage point. For something like the 10-year treasury, that sounds like a massive move.
It is. The research literally describes it as the largest move in decades.
Okay, and yields and prices move inversely, right? So a yield jump like that means bond prices tanked.
Exactly that. When yields shoot up that fast, it means the price of existing bonds is falling hard. It's a sharp sell-off. Investors are basically demanding a much higher return to hold that debt. But the sources say the really worrying part isn't just the bond sell-off itself.
Right. It's the combination of things happening at the same time that the analysis finds particularly troubling.
Okay, it's like unusual behavior then.
Well, normally, when the stock market gets shaky and stocks start falling, what do investors do?
They usually run for safety, right? Into bonds, like treasuries.
Exactly. They pull money from risky stocks and put it into safer treasuries. So in that situation, bond prices would typically go up and their yields would fall.
But that's not happening now. That link is broken.
That seems to be the case. Your sources keep pointing this out. We're seeing simultaneous declines in both stocks and bonds. The material calls this rare and troubling.
Why is that specific combo so bad in the eyes of the analysts you cited?
because it signals broad market stress and liquidity pressures. It suggests investors might be forced to sell everything, not just moving assets around.
Like they need cash.
Possibly. The research you provided actually compares this behavior to what happened during the really bad times, the 2008 financial crisis, and that market panic in early 2020 when the pandemic hit.
Wow. So it's not just normal volatility.
It suggests something deeper, yeah. A broader unease, maybe a scramble for liquidity, that's hitting even the traditional safe havens.
And this isn't just a U.S. issue. Your sources mentioned a global element, too.
Absolutely, that's a big piece. Foreign governments own a huge chunk of U.S. Treasuries. Think places like China, Japan.
Right. They hold trillions.
Exactly. Close to a third of the total outstanding. And the material notes that their recent reductions in holdings, so them selling off some treasuries, have also added to this selling pressure.
Okay, so that complicates things further, raises questions about global reliance on U.S. debt, maybe?
It certainly adds another layer, yeah. It raises questions about demand and who will absorb all the debt the U.S. issues.
So, okay, we've got this picture. Massive yield spike, bonds selling off, and stocks selling off at the same time. What are the main reasons your sources give for why this is all happening?
The material points to a few converging factors. One really big one is U.S. fiscal policy, basically concerns about government spending and the national debt.
What specifically about fiscal policy?
Well, it notes the debt-to-GDP ratio is climbing towards historic highs. And, importantly, budget deficits are running wider than usual.
Even though the economy is supposed to be near full employment, usually that means more tax revenue, smaller deficit.
Right, that's what makes it unusual.
Right.
And there's a specific piece of recent legislation the sources mention.
Yes, the one big beautiful bill, as the source rather pointedly called it.
That's the one. The analysis says this bill includes things like extending tax cuts plus new spending, but it's not fully offset by cuts elsewhere or new revenue.
Which means the government has to borrow more.
Precisely. The expectation laid out in your sources is this will increase annual deficits in Treasury issuance. So more supply of bonds hitting the market.
And more supply generally means lower prices, higher yields, basic economics.
Exactly. It puts upward pressure on yields. Your material does mention the bill had some efficiency measures or cuts, but the analysis suggests they just weren't enough to balance out the new borrowing needed. That's making investors nervous about the long-term fiscal path.
Okay, so fiscal worries are a big driver. What else is contributing?
Well, trade and geopolitical uncertainty are definitely mentioned. Things like escalating tariffs, ongoing trade tensions, they add a layer of unease.
How does that play out? Sometimes bad news makes people buy bonds for safety, right?
It can, initially, like a brief flight to quality. But the sources suggest the broader uncertainty these things create about global growth, about political stability, that tends to fuel volatility and can ultimately contribute to sell-offs as people just feel less certain about everything.
And then there's the economy itself, inflation, growth expectations.
Oh, absolutely. The bond market is super sensitive to that. Its volatility is tied up with inflation trends and signs of whether the economy is speeding up or slowing down.
And what are investors thinking now, according to the sources?
It seems investors are recalibrating expectations. The material suggests they might be starting to price in a potential economic slowdown or recession, and that shift in outlook is a huge factor driving yields.
Okay, so those are the big economic and policy drivers.
Yeah.
But your sources also mention technical signals, like things on the charts.
Yes, exactly.
Yeah.
The material points to a specific technical event. The yield on the 10-year Treasury breaking a key ascending trend line.
Okay, technical analysis. What does breaking an ascending trend line actually mean? Why is that significant?
So imagine drawing a line connecting the rising low points on a yield chart. That line acts like a floor, a level of support. When the yield falls below that line,
It breaks through the floor.
right, it signals that the previous upward momentum, or that support level, has failed. And the source finds it particularly telling that this breakdown happened just before some major jobs data came out.
Implying what?
It suggests that maybe the institutional investors, the so-called smart money, were already positioning for economic weakness. Weakness that maybe wasn't obvious yet in the main headlines or to the broader market.
So the bond market might be seeing something under the surface, a disconnect.
That's exactly the argument your sources make. They talk about a potential disconnect between perception and reality. Headline unemployment might look low.
Yeah, the numbers often look pretty good on the surface.
Right. But the material highlights potential underlying labor market weaknesses.
Like what kind of weaknesses?
Things like Maybe more people working part-time when they want full-time work, or signs that wage growth is stalling out. Things that suggest the job market isn't quite as robust as that main unemployment number might suggest.
Okay, I see. So the bond market, being forward-looking, sees these cracks maybe
Mhm.
and anticipates a weaker economy ahead.
That seems to be the interpretation in your sources, yes.
Yeah.
And if the bond market thinks the economy is weakening, it also starts thinking about a more fragile job market.
And why does that matter for yields?
Because if the job market looks shaky, that increases the odds that the Federal Reserve might have to step in later and cut interest rates to support the economy.
Ah, okay.
So the bond market, according to this analysis, appears to be anticipating earlier Federal Reserve rate cuts than perhaps the consensus view expects. That adds another whole layer to what's driving yields.
And the yield curve itself often comes up in these discussions, doesn't it?
It does. Your material references the yield curve, the graph showing yields for bonds of different maturities, calls it a historically reliable recession predictor.
Mm-hmm.
And it says that weird shifts, or especially inversions, where short-term yields actually go higher than long-term yields, those signal growing concerns about future economic contraction.
Because normally you'd expect to get paid more for locking money up longer, right?
Exactly. If that flips, it suggests the market is really worried about the near-term future, making longer term seem relatively safer or less bad, implying trouble ahead.
Okay, this is a lot to unpack. We've got the signals, the drivers, fiscal, trade, economic expectations, and these technical confirmations. Let's bring it home. What are the actual real-world consequences of these rising yields?
Yeah, the impact is pretty significant. It hits the government, but it definitely filters down to individuals, to you.
How does it hit the government first?
Well, for the U.S. government, higher Treasury yields mean it costs more to borrow money to fund everything, including paying interest on the existing massive debt.
Which we already said is nearing historic highs.
Right, so this immediately bumps up debt servicing costs. Your material points out this reduces the government's fiscal flexibility. Money that has to go to paying interest can't be spent on other things. It can crowd out spending on critical programs.
Okay, that makes sense. And how does that translate down to, well, to me, to our listener?
This is probably the most direct impact for most people. When the government's borrowing cost goes up, that benchmark, Treasury yield banks and other lenders, tend to raise their rates too.
Ah.
So you end up facing higher mortgage, auto, and business loan rates.
Ouch. So buying a house, getting a car loan, maybe trying to expand a small business, all that just got more expensive.
That's the direct effect, yes. And that has knock-on effects for the whole economy, as the sources highlight. Higher borrowing costs can dampen consumer spending and investment.
Because people and businesses put off big purchases or projects if financing costs too much.
Exactly. They might delay buying that house, or the company might postpone building a new factory.
And that ties back to the recession risk we talked about earlier.
It absolutely does. Those higher borrowing costs, mixed with the fiscal uncertainty, maybe a weakening job market, it all increases the risk of an economic slowdown or recession, according to the analysis.
Your sources also brought in some specific expert voices. What were they saying?
Yeah, a couple of perspectives were highlighted. Matt Fabian from Municipal Market Analytics, he apparently voiced concerns about the federal government's long-term operational credibility.
Operational credibility. That sounds serious.
It's strong language, yeah. It points to a pretty fundamental concern about the fiscal path. And then Thomas Urano at Sage Advisory, he noted how this unusual simultaneous sell-off in both stocks and bonds is creating pricing distortions and uncertainty.
Making it harder for policymakers like the Fed to know what to do.
Exactly. It complicates their response significantly. And sort of a general theme from the analysts cited in your material was this caution that maybe the Fed's usual tools,
Like just raising or lowering interest rates.
right, those traditional monetary policy tools might not be enough this time.
Why not?
Because, as the sources put it, the underlying problems are seen as largely political and fiscal rather than purely economic. It's not just an inflation problem the Fed can easily fix. It's tied up in government spending choices, debt levels, trade policy, things that require political action.
That suggests that the solution isn't just in the hands of the central bank.
That's the strong implication, yes. It might require more than just tweaking interest rates.
Okay, let's wrap this up then. Bringing it all together, what does this mean for you, the listener, navigating your own finances right now?
Well, first off, that personal finance impact is very real. Those rising rates on mortgages, car loans, credit cards, they hit your budget directly. So the sources implicitly suggest that keeping a close eye on interest rates is, well, more crucial than ever.
Makes sense. And staying aware of the bigger picture, too, the policy stuff.
Absolutely.
Yeah.
Your material really stresses the importance of monitoring policy developments. What happens in Washington with spending and debt, how trade negotiations play out, even things like credit rating updates for the U.S.
Because those are the root causes, according to the analysis.
Yes, since the sources frame these as key drivers, understanding those political and fiscal developments is really important for anticipating market moves and protecting your own finances. It's not just watching the news, it's practical financial awareness.
So summing up this deep dive into your sources, it paints a picture, a pretty complex and maybe concerning one, where the U.S. bond market is sending up some serious flares.
Yeah, that sharp yield rise, the fiscal worries, global uncertainty. It's all challenging that traditional view of stability and confidence in a core market.
And as borrowing costs rise and we see this weird market behavior where stocks and bonds fall together, the ripples spread out, right? The sources make it clear the implications go beyond Wall Street to everyday American.
Definitely. Understanding these signals is pretty key for anyone trying to make smart financial decisions right now.
So here's a final thought to chew on, drawing directly from what those experts in your sources were hinting at.
Okay.
If they're right, if the core issues driving this are largely political and fiscal rather than purely economic, well, what does that really tell us about the path forward? Who actually holds the keys to fixing this or navigating these warning signs? What does it mean if the solution depends as much on political will and compromise as it does on traditional economic levers? Makes you think, doesn't it?